Thanks for clicking. Canada's mortgage rates are up in November, for the most part, as the banks and the lenders are not responding to a major decrease in bond yields that we've seen since this point in time last month. This comes at a time when the OECD is urging the central banks not to slow down on the pace of rate hikes, even amidst economic uncertainty, and the St. Louis Fed is predicting that interest rates could go as high as 5 to 7%. Right now, the US is at 4%, and the Bank of Canada is at 3.75. With that said, Canada's inflation data coming out of October showed that mortgage interest costs are at a 30-year high, with an 11.4% increase since October of last year. Indeed, with adjustable rates up 3.5% and fixed mortgage rates, those rates being offered at renewal, much higher than they were 5 years ago, the amount of money going towards debts is obviously increasing. So what I want to do today is go over my best mortgage rates for November, take a look at how much mortgage payments have changed since Canada's real estate peak in February, go over the fixed mortgage rates from 5 years ago to see how much payments are changing with current renewals, and then discuss what to look for next. Speaking of next, the end of the month is upon us, and we're expecting the local real estate boards to start releasing November's data late next week, and we'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. On to the mortgage rates. First up, the best 5-year insured mortgage rate. An insured mortgage, if you'll remember, is where you put less than 20% down. You have a 25-year amortization. You qualify at the contract rate plus 2% or 5.25, whichever is higher. And you pay the mortgage insurance. The best 5-year fixed insured rate in September was 4.49, followed by 5.04 in October, and as of right now, that rate has risen to 5.29%, with the best insured variable rate at prime minus 1.05 or 4.9. So on an insured mortgage rate, we're up about a quarter point since this point in time last month, and about 0.8% since September. And insurable rates are up as well. An insurable rate is where you have 20% down, you have a 25-year amortization, and you qualify based off the contract rate plus 2% or 5.25, whichever is higher, and you don't pay the mortgage insurance. The best insurable rate in September was 4.79, followed by 5.24 in October, and is now 5.39, with the best insurable variable rate at prime minus 0.5 or 5.45. So insurable rates, those rates where you put 20% down and you don't pay the mortgage insurance, up about 0.15% since this point in time last month. In uninsurable rates, those rates are actually down this month. An uninsurable rate, if you'll remember, is where you have 20% down and you have a 30-year amortization or you take money out of your home, vis-a-vis a refinance or an equity takeout, etc. In September of 2022, the best uninsurable rate was 5.24. That was up to 5.54 in October, and as of right now, that is down to 5.44, with the best uninsurable rate being prime minus 0.5 or 5.45%. So it's actually less expensive right now to go with a fixed uninsurable rate than it is to go with a variable. Strange times. So in summary, the insured rate up from October, the insurable rate up from October, and the uninsurable rate down about 0.1% since this point in time last month. But how much have mortgage costs changed since the peak of our real estate market? Back in February, at our peak, the price of a home was $816,000, and a decent adjustable rate was prime minus 1, or 1.45%. With minimum qualification requirements, that average payment worked out to $3,142. Now, with prime rising from 2.45 to 5.95, that adjustable rate mortgage now has a payment of $4,574. So that's about a $1,400 increase in the period of about 8 months. But what about those homeowners that bought 5 years ago and are now receiving their mortgage renewal letters? According to the Wayback Machine, a decent 5-year fixed insured mortgage rate in November of 2017 was 3.39. According to the Canadian Real Estate Association, the benchmark price of a home in November of 2017 was $562,500. If we use minimum down payment requirements in a 25-year amortization and a 5-year fixed 3.39 interest rate, we get a mortgage payment of $2,726 with $476,000 due at the end of the term. Now let's look at current interest rates. If we use a 20-year amortization, because 5 years have been paid off, and we use a 5.29 interest rate that's available on an insured mortgage on $476,000, we get a payment of $3,201, or about $500 more than they've had for the past 5 years. So, holders of adjustable rates, if they bought at the peak, obviously everyone's going to vary, but if they bought at the peak, they're looking at about an extra $1,400 since their payment started in February. Holders of fixed rate mortgages who bought 5 years ago, on average, using the benchmark price, are looking about an extra $500 more than they've been paying for the past 5 years. So, fixed rate mortgages up despite the major decrease in bond yields that we've seen since October. But why are yields down so much since this point in time last month? The main reason is the inflation data hasn't come in as hot as the markets thought it was going to. So there's a real idea out there that the Fed is going to pivot, that the Bank of Canada is going to pivot, that they're going to either slow down massively, move down to 50 and 25 basis point rate hikes rather than the 75s that we've been seeing, or they're going to be at the point where they're going to pause. But while yields are down, many experts in the US, the presidents of the banks of the Federal Reserve, are coming out and saying that the interest rate hikes are going to continue, regardless of what the bond yields say. So it's just not clear yet that the bond market, that the bond yields, which we've talked about on other videos on this channel, are accurately pricing in the extent to which the central banks are going to keep hiking. So my guess is this is why the banks, the mortgage lenders, are not following one-to-one with the bond yields, are not lowering mortgage rates simply because bond yields are down from this point in time last month. With that said, we will get a much better idea of the Bank of Canada's thinking on how fast it wants to continue to raise rates at its next announcement on December 7th. We'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.